Greetings viewers. I welcome you all to the series on security analysis and investment management. I am Dr. Isha Raval, working in the capacity of Associate Professor and Internal Quality Assurance Cell Coordinator at Vivekananda Institute of Professional Studies, Delhi. In today's session, we will be discussing about what are the different types of financial instruments which are traded in the capital markets, with special emphasis on debt securities or debentures, and we will also be covering the aspects related to the derivatives segment. In the beginning, let's discuss what are debt securities, what are debentures. So debentures are the certificates or the creditorship securities which are issued by the company to the public when there is a need of capital, either for expansion or for development. But there is a clause here: when the company does not want to dilute its share capital, when the company does not wish to offer the voting rights to the people who are lending money, then in that case a company opts for issuing a particular debenture, or you can say that it is a debt security. So debentures are actually the liability of the company, which are to be repaid in a specific time period, however a feasible alternative for term loans for companies. That means when a company wishes to expand, when a company wants to develop, wants to take up funds, the two alternatives which a company has is that one, you can opt for a bank loan, and the other alternative is to raise funds in the debt market. As far as the company's credit worthiness is concerned, if the company is going to a bank for opting for a loan, then there are multiple formalities which the company has to undergo. Similarly, when the company issues debentures in the wholesale debt market, there are certain guidelines which a company has to follow. So it is for the organization, the company, to decide whether they want to opt for a bank loan or whether they want to go for debt securities. Now, the equity shares, which are actually providing the ownership right to an organization, the ownership right to the investors, they yield a much higher return on the total investment in the stock market. But if an investor invests in the equity shares, there are a lot of risk associated as well. Therefore, an equity investor or an investor per se may decide whether to opt for equity share or a debenture. So there are a lot of benefits which are associated with a debenture vis-a-vis an equity share, because somebody who is putting funds in the equity market is taking a lot of risk, a whole amount of risk, and the quantum of risk is much higher than a person who is investing funds in the debt market or in the debentures of the company. So alternative investment options in the form of debt instruments, they can be undertaken by such investor who has a lower risk appetite, who does not want to burden himself with good amount of risk. But when there is low amount of risk, similar are the returns. Therefore, a person with a low risk appetite, who is risk averse, may opt for a debt security, but somebody who is really comfortable taking risk, who understands the nuances of the market, may opt for equity shares. From the company's perspective, they can either issue a debt or security, or they can issue an equity share. The company may opt for a bank loan. So given all these three options, if a company does not want to dilute its ownership rights, it does not want to dilute the structure, how the shares have been distributed, then they opt either for a bank loan or a debenture. So the most likely benefit, which we can say, or preference which is taken by the company, is a debenture. There are certain features of these debt securities. The first feature is that they are borrowed funds. Debentures are the capital funds that are borrowed by the authority bodies from the public while seeking for a capital. So capital is required, money is required, but the company does not want to repay the capital to the investors within a stipulated period of time. So when a person who is a company who is in search of funds does not want to dilute the shareholding pattern, does not want to dilute the voting rights, will actually opt for issuing a debt security. because since it is a debt, it will be repaid and the maturity period is specified. Another interesting feature of a debenture raise or a debt security is that it is always having a fixed rate of interest, which is also known as the coupon rate. This rate of interest is something which needs to be paid back to the investors either once in every 6 months or annually, as it is decided in the AGM. Whenever the shareholders decide that they are going to repay the interest rate, they are going to pay the interest rate 6 monthly or whether it is annually, this decision is taken. So every debenture holder or every debt security holder is entitled to get certain amount of interest which is already fixed at the time of issuing of those debentures. And whenever we see any debenture, it is always say 6% debenture, and we have the duration and the coupon rate, the fixed rate of interest mentioned on it. Then the payment of interest is mandatory. That means a company who's not getting profit, who's not making any money, it is mandatory for the company to make payment of the interest. The company is obligated to the debenture holder interest payment in priority, irrespective of the condition of profit or their loss in business. That means the debenture holders are entitled to whatever commitment has been made at the time of issuing of debentures. So given a choice from the perspective of an investor, it is said somebody who wants a fixed rate of interest, or somebody who's looking for a fixed payment after every interval, maybe 6 months or 1 year, opts for debentures, opts for debt securities vis-a-vis the stock market shares. Debentures also provide a kind of security, because for God forbid, if something goes wrong in the organization, if the company becomes bankrupt, or if the company dissolves, or if the company files in for liquidation, then in that case, debentures holders, they have a security, because that is, the assets are kind of a collateral available to these debenture holders. Even if the company becomes insolvent, the debenture holders will get their money by selling the assets of the company. Therefore, the financial assets of that per specific organization, they work as a collateral, as a security, and the debenture holders, they feel safe that we are going to get the 6 monthly or annually interest. And God forbid if something goes wrong and the company dissolves or goes into liquidation, even there, the amount which they invested, the amount which they have lent to the organization, they are going to get back that particular amount. Whereas the equity shareholders do not have this benefit. Now, redemption. As I said, that when a debenture is issued, it is always issued with a specific time frame. That means the sum which is borrowed by the company, the sum which is borrowed, the funds which it has taken from the debenture holders, they are to be given back. They are to be given back at the time of maturity of that specific debenture. So we say that the debentures are redeemed, and the redemption period is specifically mentioned in the company's prospectus on the completion of the fixed period of time, or the date at par. It can be premium or even at discount. So redemption can happen either at premium or at discount, or even at the face value of the debenture. But this is pre-decided, and the redemption period is specifically mentioned in the company's the prospectus at the time of issue of the debentures. Now, interestingly, because debentures or debt instruments, they are actually a loan. They are not giving any sort of ownership to the purchaser. That is why the debenture holders, they are the creditors of the company. That means they are the lenders. And somebody who is lending you money will never get a voting right in the organization. Therefore, one of the important features of a debenture is that the debenture holder does not get a voting right on any sort of internal matter of the company until their rights are being attached or the company asks their opinion in special circumstances. So given the normal condition, given the normal working of the organization, if everything is fine, then the debenture holders in normal circumstances do not have any specific voting right. They cannot intervene in the internal matters of the company, and they have no say in the functioning of the organization. They cannot deal in the operational processes of the organization. Then, whenever a debenture is issued, a trustee is appointed. At the time of issuing of debentures to the public investing in the company, a deed is signed by the person appointed as the trustee. The person who is appointed as the trustee, he is supposed to ensure that the borrowing firm fulfill all its obligations, mentions whatever is available, and then they have to be clearly specifying that what is the purpose of issuing the debenture, what will be the maturity, when will they get redeemed, what is the rate of interest which is going to be given to the debenture holders. So appointment of trustee is an important feature, because somebody who is lending money and is buying the debenture should know who is answerable, who is taking care of these financial instruments. Then convertibility. The debentures, as we said, they are actually the loans, but they have the option of convertibility. That means the company may issue convertible debentures at the option of the debenture holders, which can later be converted into equity shares. That means somebody who is lending money, who is buying the debentures, who is entering into the debt instrument, can later opt for converting their debentures into equity shares. So these sorts of financial instruments, such debentures, are known as convertible equity shares or convertible debentures. Now, because we have understood what are the debentures, what are their features, and what all do they give to the investor, let us have a look at what are the different advantages attached to the debentures. The company, without giving ownership rights, can actually raise long-term funds. That means no intervention, no voting right being given, but you are getting long-term funds. Funds may be for 15 years, for 20 years, or 5 years. So long-term funds at the disposal of the company without diluting its ownership. That's one important advantage of debenture from the perspective of an organization. The interest amount to be paid on the debentures, it always remains constant. That means if it is written 5%, that is the coupon rate which is written on the debenture, irrespective of the ups and downs of the market, irrespective of the inflation rate, irrespective of the interest rates, this 5% remains constant. So somebody who's investing in the debentures is assured that 5% is the bare minimum which he or she is entitled to get and will certainly get, without being concerned about the ups and downs in the market, without even bothering about the volatility of the market, the fluctuations of the interest rates. So someone who wants an assured return can opt for a debenture. Even at the time of liquidation, the debenture holders, they are always on the top priority. They are the first ones who are redeemed. They are the first ones to whose claims are settled, even by selling the assets of the company. So this is one important characteristics of debentures which make them a very safe investment. So you're lending, getting a fixed rate of interest, but you're also getting the priority to get back your money in case something goes wrong with the organization. So that is why debentures, they are considered to be less risky than shares from an investor's point of view, as and when you invest in these debentures, it is one of the safest option, though it will always give a profit in return. So there's a guarantee of return, there is a guarantee of the money which you have invested today, guarantee of return, and you feel safe, unsecured, which is not the case when you put your funds in the equity market or in the shares. Obviously, every coin has a head and a tail, so there are pros and the cons of every financial instrument. Let us understand what are the disadvantages of debentures. The debenture holders, they are the creditors of the company. Thus, they do not have any voting rights in the matters of the company. So, if a company decides, a PSU decides to go, to privatize. So, being a debenture holder, you will not have any say in stopping the organization for opting for privatization. So, any major decision which is taken by the organization, the debenture holders have no say because they do not have any voting right. The interest on debenture which you get is fully taxable on the company's income. So, it is a tax deductible expense, and also it becomes challenging to pay the debenture capital when the economy or when the company faces crises like depression. So, during COVID times, if you remember, it was very challenging for the organizations to pay the bare minimum interest rate which was attached to the debenture. So, the debenture holders as an investor feel safe, but it is quite challenging for the companies if they commit that yes, they are going to pay this much bare minimum of interest rate as the coupon rate. They face problem when the business is not going fine. In fact, debentures, they actually increase the cost of capital because when you are issuing the debentures, the brokerage, the commission which is paid is pretty high. So, by now we have understood what are debentures, what are their features, what are the advantages and what are the disadvantages of the debentures. One very important financial instrument which is gaining a lot of momentum and is getting attracted, the investors are getting attracted towards, are the derivatives. The derivatives market is very, very, very risky. Somebody who does not feel safe, somebody who is a conservative investor will certainly stay away from the derivative segment. As the name itself suggests, derivatives, that means a financial asset, a type of financial contract. So, somebody who wants to take a derivative on Sensex, somebody who wants to take a derivative of Nifty can opt for it. So, these derivatives are the per se, they are a financial asset which is deriving their value. The value of a derivative is being derived from the underlying asset. That underlying asset can be any financial asset, as I just mentioned. The value of the underlying assets, it keeps changing. The prices of equity stocks change, the prices of bonds change, there are a lot of fluctuations in the currencies, there are a lot of fluctuations in the prices of the commodities. So, the value of the underlying assets, it keeps changing according to the market condition. Therefore, the basic principle behind entering into a derivative contract and profits is by speculating the volume of underlying assets in future. That means, if you anticipate that the prices of say wheat are going to rise or the prices of gold are going to rise, you will try to buy the derivative, a forwards contract. You may enter into a futures contract or you may take up a call option or a put option depending upon your prediction. So, a lot is dependent on what are you predicting, what sort of future is visible. On the basis of the future, you are taking a decision today to buy or sell an underlying asset. To substantiate, let us understand with an example. Suppose there is a farmer who is producing, say, wheat, and he is expected to sell 10 quintals of this wheat after, say, 4 months at rupees 2,000 per quintal. We are just taking a hypothetical example, but he has this, he's a little afraid and has this at the back of his mind that due to rain, the prices of wheat may go down. That is why, to avoid his risk, he can enter into a forward contract with the broker and say that he is going to sell 10 quintals of his wheat, whatever he is producing, after 4 months at a price of rupees 2,000. Now, tomorrow when the price, say after 4 months, the broker comes to him and says that you promise that you're going to sell your 10 quintals at 2,000 per quintal, please give it to me. Now, the farmer who has already done the production, has the sufficient amount of wheat with him, will see what is the level in the market. Suppose the market, in the live market, the price of wheat is 1,970. Now in this case, that can be because there is good supply in the market, the production of wheat was very good, and that is why there is surplus supply. Now the farmer will say, wow, I've made a profit of 30 per quintal, so he is going to sell it off. In any case, because the farmer has already entered into a contract with the broker stating that he's going to sell it at 2,000 per quintal, so he's going to make a profit of 30 per quintal in this case. But what if the price goes from, say, 2000 to 2020 on the date at which the agreement was made? So after 4 months, if the price is 2020, the farmer cannot take a back seat. Now he mandatorily have to sell these 10 quintals of wheat to the broker at 2000 only. So in this case, the farmer is likely to make loss. So it is all speculative in nature. That means when you predict the price to rise, you say that you're going to sell it and you already decide the higher price and you say that I'm going to sell it at 2000. But the prices in the current market, the prices in the spot market or in the cash market, they are completely dependent on the demand and supply of that particular commodity. So in this case, the example which I just cited, if the supply is on the higher side, the prices will fall and the farmer will make a profit. But if there is too much of demand in the market and the prices in the cash market or in the current spot market are higher, the farmer is likely to incur a loss. Now, when we talk about such derivative instruments, there are various types of derivatives which are available. Like we have a forward contract, a futures contract, swaps, and then we have options. The example which I just cited was the example of a forward contract. A forward contract is a non-standardized contract between the two parties to buy or sell an asset at a specified future time at a price agreed upon today. So as I said, in this case, when the farmer commits in the market to a broker, I am going to sell 10 quintals of wheat at 2000. This is an example of a forward contract. That means the farmer has no choice but to sell. But there is a clue here. Forward contracts, they are non-standardized. They take place in unregulated market. So if the broker comes and the farmer says that I'm not going to sell, the broker has no say. He will say, no, you will have to sell. But the farmer may say and deny selling because he knows that he can get a better price outside. There is no regulator in between. This is an example of a forward contract. If we say we move from forward to futures, the same contract which is regulated, a standardized agreement, if it takes place between this farmer through a platform, through a regulator, then in that case, it will be said a futures contract because the farmer cannot deny, the person who is buying cannot deny. So the buyer and seller mandatorily have to honor their transaction, where there is a mandatory obligation on both the parties that they have to honor the trade, then it becomes a futures contract. A futures contract is a standardized contract which is traded on these centralized exchanges, and they can be considered as a sort of bet between the two parties. So both the parties decide, I am going to buy at, say the buyer says I'm going to buy at this particular price after say 30 days, and the seller says, okay, I'm going to sell it. They have to honor this specific contract. So there is no taking a back step, because if any of the parties denies to honor a futures contract, they understand that there is a regulator and a penalty will be levied and an action will be taken against either of the parties who takes a back step. The third category is options. An option is similar to a futures contract with just one twist. And the twist is that in the futures contract, there is an obligation to buy, there is an obligation to sell. Whereas under options, as the word itself suggests, the person who is either buying or selling the option has the option to honor or not to honor the contract, for which he or she agrees to pay a premium, which is known as the option premium. There are two types of options. The first is the call option and the second is the put option. Under call option, the same example. If the farmer says, I am going to sell 10 quintals of wheat at 2000 rupees after say 4 months, he will buy a call option maybe at a price of rupees 5 or 10 and say that after 4 months I am going to sell this particular amount, that means 10 quintals of wheat at 2000. On the day of after 4 months, on the day of when the option is getting expired, the farmer sees that in the current market, in the spot market, the prices are 2050 per quintal. The farmer will say that let me forego the 5 rupee premium which I have already paid, let me incur a loss of 5 rupee here and make a benefit of 50 rupees in the spot market, in the cash market. So here there is no penalty on the farmer. The farmer may not exercise his call option. Instead, he will forego the option and sell the amount, the quantity in the cash market. The other example is about the put option. Put option gives the buyer of put option the right to sell but not an obligation to sell, which is going to be exact in contrast to what we studied in the call option. Here the buyer will say I am going to sell, but the buyer of the put option will say I am going to enter into this contract, but he or she may not be under the obligation. There is no obligation, it is only the right which he is buying to sell a particular thing. So this is all about options. And the last category, the last financial instrument under the capital markets and under the derivatives market specifically is swap. A swap is the most often a contract between two parties agreeing to trade long term, and one party is actually swapping the interest rate. There are two types of interest rates. One is the fixed interest rate and the other is the variable interest rate. So when both the parties, somebody who has taken loan at say a fixed interest rate wants to switch from the fixed interest rate to the variable interest rate, then in that case he or she may opt for a swap with somebody who's already has already taken a variable interest rate. So there is a swap of the interest rate from fixed to the variable, and both the parties repay each other's interest amount. That means they are actually switching the interest rates, but there is here somebody who predicts that the interest rates will rise the interest rates are going to rise in the future. Then they say that let me opt for a fixed interest rate, but the other one predicts or is anticipating the interest rates on loans will go down. Then in that case they may opt for variable interest rate. So when two such people, one who is looking for fixed and the other who is looking for variable interest rate, they swap these interest rates and agree to repay the loan amount, the interest of each other. That is an example of a swap. So in today's lecture, we have understood what are debentures, the features, the advantages and disadvantages, and then we also had a look at what are derivatives and the various derivatives instruments which are traded. The first one being a forward contract, the second is a futures contract. We studied about options and swaps. I hope you enjoyed learning. Thank you so much. Happy learning to all of you.